Hey, Courtney Smith here, and I want to talk about a couple of things that are happening in the background of the Silicon Valley bank crisis. So, this is the front page of the Wall Street Journal market section from yesterday's paper. Now, yesterday, I'm recording this at 1:04 a.m. Eastern Time. Okay, now I'm in Dubai right now, so it's a very pleasant morning for me. But here's what we're seeing. And there's some important ramifications because this is what's happening underneath the surface of the banking crisis. Market stress snarls trading in U.S. Treasuries. Now, this actually started earlier, and I'm going to go back several months. We had Liz Truss was elected by the Conservative Party to head her party and become prime minister. Almost immediately, pension funds in the UK started to collapse because her Chancellor of the Exchequer, or Treasury Secretary, started to hike interest rates. That then led to a sharp drop in the value of the existing UK gilts or treasuries. Now, does that sound familiar? Does that sound exactly like what's happening in the United States? Yes, except that it happened first in the UK. Now, here's what the problem was. That collapse in the value of the UK gilts damaged the value of the pension funds in the UK, causing a pension fund crisis. And that was one of the proximate causes of why Liz Truss was kicked out of office. The pension funds all ganged up and went to the government, went to their members of parliament, and complained bitterly because, of course, pension funds have to have fairly stable, if not increasing values in their portfolio in order to live up to their obligations on the pensions that they're providing for old people down the road. That wasn't going to happen with the tightening that the Bank of England had done. Now, here in the United States, we haven't heard about any pension funds coming under stress because pension funds largely invest in U.S. Treasuries. Now, remember in the video that I did yesterday, and I highly recommend you watch it just to understand what I'm saying right now. Pension funds are going to try to keep everything in an investment portfolio. They don't market to market. They just hold it to maturity, and therefore they're not going to have the kind of stress that they have in the UK, which has a different accounting standard. But nonetheless, here we are on the front page of the Wall Street Journal market section, and you're seeing yields on government bonds slide amid sharp fall in liquidity. So over here on the left-hand side, let's take a look at the red line. These are two-year treasuries, and this is bond yields on these treasuries just this month. Okay, so bond yields were creeping up, getting over a little over 5%. Let's call it 5.05. And in the last 2 weeks, we got down to 3.75. Now, that's a dramatic fall in yields as investors rush towards highly liquid instruments, and the most liquid instruments in the world are U.S. Treasuries. All of a sudden, they're not liquid anymore. So they're having to bid up the price, which means yields are dropping, and so we're having this dramatic cut in interest rates. Now, I've talked in previous videos about the Volcker mistake, which is where Paul Volcker eased monetary policy too quickly. Well, what's happened here is because of the stress of the rising interest rates. Now, remember, I said yesterday, markets are homeostatic mechanisms. Homeostatic mechanisms, like your thermostat, okay? So interest rates got too high or too hot, and so that led to crises in the banking system, which then means that everybody rushes in and drops interest rates, which is a form of easing. So now all of a sudden, technically, probably mortgage rates will, with a lag, start to come down rapidly, which will stimulate the housing market. Do you see what I'm saying? It's a homeostatic mechanism. When something goes too far in a free market, not in a controlled market like short-term treasuries, it always goes back to an equilibrium. So here we see that that the price was too high for the market, and by the market I mean including the balance sheet of banks, and there was an effective easing in the treasury market. But why is there a lack of liquidity? It's because nobody wants to sell. Nobody wants to sell. How do I know it's a lack of sellers? Because the prices skyrocketed. Okay? Which means that the people that wanted to buy had to bid up the price in order to get treasuries. And when you bid up the price of treasuries, that means yields fall. Now, the other thing not covered so much in the United States is, let's go down over here. Credit Suisse, will borrow up to $53.7 billion. Now, this is I believe it's the number 3 Swiss bank. I used to be the treasurer of the 4th largest Swiss bank, but this is the 3rd largest Swiss bank. It's a huge bank, and they've been beset with problems for the last several years, quite frankly. There's just been serious problems there, money laundering, credit losses. I mean, it's really been a very, very poorly run bank for a number of years. Don't ask me the exact number, but it could be up to the last 5 years. It's been lurching from crisis to crisis. The Saudi sovereign bank came in, I think it was about a month ago, and said they were going to invest $10 billion. Then yesterday, apparently Credit Suisse went back to them, and the Saudis turned them down for more money. They said that's enough. So then Credit Suisse is now going to borrow a bunch of money, which really means their balance sheet is now going to be weaker than it was a week ago because they'll have more debt. The Saudis had invested equity. So this is what's going on here. We're seeing pressures in the market from all over the place. On the other hand, we're seeing very quick action by the U.S. Treasury to come in and make all depositors good at Silicon Valley Bank and Signature Bank and First Republic, et cetera, Silvergate. So they're coming in and saying, oh, don't worry about it. We're covering everybody's deposits, which over the long run is a bad thing because now everyone will think that 100% of their deposits are insured when only 250,000, and when a big banking crisis comes along, the government won't have enough money to pay for it unless they print it. Oh my goodness, the Fed can print electrons instantly, no cost. Electrons are free to produce. So the Fed will of course print all the money in the world, and we will lurch from crisis to crisis as we have since 2008, then COVID. The response of the Treasury will be to lower interest rates to zero and put in trillions of dollars as we decide to follow the excellent foresighted bankers down in Argentina as they go belly up every few years. All right, that's what we're doing. We started to move into Banana Republic banking, central banking in 2008. And we've exacerbated it since 2020. Not just the U.S. European Central Bank, same thing. Bank of Canada, same thing. Bank of England, same thing. The orthodoxy now is to do what Argentina did. All right, I wanted to show you some of these other stress points here because some of these will become headlines in the future. But right now they're background features. But you don't want to see the background. You want to see the total picture because, of course, you're a wise and prudent investor. We'll talk to you later.